Hyatt just dropped their Q2 2026 earnings. And it is definitely a mixed bag. They beat on the bottom line but missed slightly on consensus revenue
Yeah,
estimates.
it's a complicated print.
Right. So let's just get the headline numbers out of the way. Diluted EPS came in at $1.14, with adjusted EPS at $1.12, so that comfortably beats Wall Street's expectations.
Mm-hmm.
But then total gross fees hit $324 million. That's a 7.8% increase year over year, but it still fell, a hair short of the Street's top-line whisper numbers.
Exactly, and the guidance reflects that same sort of tension.
Yeah. Full year 2026 guidance is projecting system-wide hotel RevPAR growth between 3.5% and 4.5%. Net rooms growth is expected right around 6%, and adjusted EBITDA is projected between $1.155 billion and $1.205 billion.
And, well, the market reaction tells you how investors are digesting all this. Shares dipped about 1.5% in pre-market trading.
Right, because of those mixed signals.
Yeah. I mean, if you just glance at the top-line profitability, you see a hospitality giant that's basically printing money. But, and this is key, if you actually look under the hood, you realize Hyatt is quietly attempting this really radical high-wire business pivot.
Right, in the middle of some pretty brutal macroeconomic headwinds, especially in certain global markets.
Exactly.
So for everyone joining this deep dive, our mission today is to get past those headline beats and misses. We're going to unpack the core drivers behind Hyatt's Q2 performance for you.
Because you really can't evaluate a global footprint like Hyatt's as just one uniform entity anymore. The macroeconomic crosswinds are, well, they're pulling the portfolio in completely opposite directions.
Right, so we need to dissect those massive variations between their different operating segments. We'll analyze management's commentary on the structural risks lurking in the back half of the year and give you the concise financial breakdown you need to actually understand this business model.
You have specific brand scales that are generating just staggering amounts of reliable cash flow. And they're essentially subsidizing other regions that are acting as heavy anchors on the overall performance.
Yeah, so let's jump straight into those operational metrics at the property level because, like you said, there's a massive divergence here.
It's basically a tale of two entirely different hospitality ecosystems living under the exact same corporate umbrella.
Totally. So on one hand, comparable system-wide hotels saw a 5.9% increase in RevPAR. And just quickly, for anyone new to hotel stocks, RevPAR is revenue per available room.
Right, it's the golden metric.
Yeah, it blends occupancy rates with the average daily rate. So it shows you how much money a hotel is actually squeezing out of its total physical footprint, whether the rooms are empty or full.
And that 5.9% system-wide growth, it was not evenly distributed at all. It was heavily, almost exclusively, fueled by their luxury and upper upscale segments.
The pricing power there is insane right now.
It really is.
Yeah.
You dig into their supplementary stats. The Park Hyatt brand is commanding an average daily rate of over $456.
Wow. And that's just to sleep there.
Exactly. That's the baseline cost to just sleep in the bed. That doesn't factor in dining, spa services, event space, none of it. And then the Unbowed collection by Hyatt, which is their portfolio of independent premium boutique properties, their RevPAR jumped nearly 13%.
Right, and a huge driver of that system-wide strength is happening right here in the U.S. market, which saw a 6.7% RevPAR increase. Management actually specifically called out events like the FIFA World Cup as a notable boost to this domestic performance.
Yeah, which might sound weird for a Q2 report.
Right, a retail investor might wonder, how does an event happening in the future impact earnings today?
Corporate bookings.
Exactly.
Yeah.
Major sponsors, broadcasters, logistical partners, they are already locking in massive blocks of premium rooms and event spaces in host cities years in advance.
And they're paying absolute premium transient rates to secure that inventory.
Right, which basically creates a pricing floor for the entire region.
It creates compression in the market. So when the luxury suites are locked up by corporate contracts, everyday leisure travelers are pushed into higher pricing tiers just to find a room anywhere.
Which drives up that average daily rate across the board.
Exactly. The traditional high-end hotel business is thriving. It's being driven by a resilient corporate traveler and a high-net-worth leisure consumer who is, basically immune to inflation.
But then we look at the other side of the ledger, the all-inclusive resorts, and they are telling a completely different story.
A much rougher story.
Yeah. The comparable system-wide all-inclusive properties saw their net package RevPAR actually decrease by 1.2% compared to the second quarter of 2025.
And just to clarify that terminology, net package rev pair is specific to all-inclusives.
Right, because guests pay one lump sum for the room, food, and drinks. So this metric strips out the non-room elements to give investors like an apples-to-apples comparison with traditional hotels.
And seeing that metric go negative is definitely a red flag.
So what exactly is dragging down the all-inclusive side of the house?
Well, the earnings report points to a confluence of some really severe regional headwinds. First, you have these prolonged security concerns in Mexico.
Right.
And the mechanical reality of the resort business is that booking windows are very long. Families plan these trips, 6 to 9 months in advance.
So the security issues in certain Mexican tourist corridors that were dominating the headlines back in Q1.
Exactly. They immediately chilled future bookings. So that softness from the first quarter dragged right into actual realized Q2 occupancy. Management did note that booking trends in Mexico are finally improving sequentially, but it's slower than they hoped.
Yeah, the recovery has been far slower than their internal models anticipated.
And then compounding that security issue in Mexico is a severe drop in airlift to certain destinations.
Right.
And airlift, just to be clear, is simply the sheer volume of commercial airline seats flying into a specific airport. Yeah, and airlines have been dealing with their own fleet constraints, right? They're shifting routes to chase higher margin business travel.
So if an airline cuts, say, 2 daily direct flights from a major U.S. hub into Cancun or Cabo.
That's hundreds of potential guests a day who literally cannot reach the property.
Wow.
Yeah, if the flights aren't arriving, your 500-room all-inclusive resort sits half empty. And the operating leverage of a massive resort starts working against you very, very quickly.
Then you throw in weather events completely outside of their control, like the impact of Hurricane Melissa.
Yeah.
The report noted that this forced hotel closures and severely impacted their Jamaican properties.
Yeah.
And the financial drag of hurricane isn't just the days the resort is physically closed.
Not at all.
It's the millions of dollars in mandatory refunds for canceled trips, the immediate drop in new bookings because of reputational damage, the downtime for physical repairs.
They explicitly noted that their distribution segment's adjusted EBITDA declined year over year almost entirely because of these temporary shocks in Mexico and Jamaica.
So looking at these two contrasting segments, it functions exactly like a diversified investment portfolio.
That's a great way to think about it.
You have the luxury and upper upscale hotels acting as your steady blue chip assets. They're generating reliable, high-margin returns that are essentially bailing out the volatile emerging market assets.
Which in Hyatt's current ecosystem are those Caribbean and Mexican all-inclusive resorts.
Right. So this raises a crucial question for anyone evaluating Hyatt's long-term viability. Is this regional volatility in the all-inclusive space, the security issues, the weather, the airline capacity problems, is that a structural flaw in the business model of relying on massive Caribbean resorts? Or is management just treating this as a temporary blip?
Management is aggressively messaging this as a temporary blip. In fact, they're framing it as proof of the genius of their broader corporate structure.
Really? How so?
Well, in his commentary, CEO Mark Hoplamazian stated that the resilience of their core fee business enabled them to absorb these temporary regional headwinds without altering their full-year outlook.
The core fee business. Okay, this is where we transition into the real mechanics of how Hyatt is making money today. Let's look at the actual cash generation.
To it.
Gross fees jumped 7.8% to hit $324 million. And they reported an adjusted EBITDA of $297 million. Now, for the retail investor listening, adjusted EBITDA is basically a metric companies use to show their pure operational cash profit. It strips out the noise of debt costs, tax rates, and accounting depreciation.
And that noise is particularly loud in this Q2 report.
Oh, yeah.
Because if you just do a simple year-over-year comparison of that $297 million adjusted EBITDA against Q2 of 2025, it looks like a very modest 3.4% increase.
Which looks pretty sluggish.
Right, it looks sluggish.
Yeah.
But you have to adjust for the massive structural changes Hyatt has made to their balance sheet over the last 12 months to see the real operational leverage at play.
Specifically, the fact that they have been selling off billions of dollars worth of physical hotel properties.
Yes. When you adjust the year-over-year comparables to account for the assets they sold in 2025, most notably, the massive Playa real estate transaction.
Where they offloaded a $2 billion portfolio of physical resorts to Tortuga resorts, right?
Exactly. When you adjust for that, the adjusted EBITDA increase isn't 3.4%. It's actually a highly impressive 8.8% increase.
Let's break down the mechanics of a deal like that, because selling off $2 billion in real estate just to make your year-over-year comps look messy, that is the execution of a very deliberate strategy.
Extremely deliberate.
Hyatt is aggressively targeting what they call an approximately 90% asset-light earnings mix.
And the mechanics of the Playa deal illustrate this perfectly. Hyatt sold the physical concrete, the swimming pools, the land, all of it, to Tortuga Resorts.
So Tortuga now takes on the massive capital expenditure burden.
Right. If the roof needs replacing, Tortuga pays for it. Tortuga pays the property taxes. But, and this is the genius part, as a condition of the sale, Hyatt retained a 50-year management agreement for those exact same resorts.
I look at this transition as the hospitality equivalent of a legacy tech company pivoting from selling bulky hardware to a high-margin software as a service model.
Yes, exactly like a SaaS model.
Because when you own physical hotel buildings, you have massive capital tied up in the real estate. You have constant maintenance, physical depreciation. You're vulnerable to local property markets.
It's expensive.
Very. But when you pivot to SaaS, or in Hyatt's case, pure franchising and management fees, you require almost zero capital expenditure.
You're just licensing the Hyatt brand software, the booking engine, the loyalty program to a third-party owner, and taking a percentage of the gross revenue right off the top.
It becomes a highly predictable, recurring revenue stream with just astronomical margins.
And the financial tables in this Q2 report show that pivot is largely complete.
Really.
Yeah. If you look at the breakdown of their $297 million in adjusted EBITDA for the quarter, $266 million of it came directly from management and franchising fees. Only $40 million came from properties they still own and lease.
Right.
They have effectively transformed into an intellectual property and logistics company that just happens to operate in the travel space.
So how does this specific operating leverage, this asset-light SaaS model, actually flow down to the balance sheet? Like, how does it benefit the retail investor holding the stock today?
It creates a massive, reliable cash flow cascade. Because management and franchise fees require virtually no capital expenditure compared to owning real estate, a huge portion of those earnings drops straight to the bottom line as free cash flow.
Right.
Hyatt explicitly states they are targeting greater than a 50% adjusted EBITDA to adjusted free cash flow conversion rate.
So for every dollar of operational profit they claim, 50 cents is pure, unencumbered cash entering the corporate treasury.
Exactly.
That is a staggering amount of dry powder for a hospitality company.
Yeah, it is.
And they are using that asset-like cash generation to aggressively fund shareholder returns. Year to date, they've returned $175 million to shareholders. In the second quarter alone, they executed a $12 million share repurchase, taking over 62,000 shares of Class A common stock off the open market, which reduces the float and artificially boosts future earnings per share.
Plus the dividend.
Right. They also declared a 15-cent per share dividend for the third quarter. Looking at the full year 2026, they're projecting between $325 million and $375 million in total capital returns.
And the critical piece of this shareholder return strategy is how they're financing it.
Right.
They were funding these buybacks purely from that asset-light operational cash flow. They are not over-leveraging the balance sheet with expensive debt.
Which is key in a high-interest rate environment.
Absolutely. The report notes they are strictly maintaining a target of roughly 3.0 times gross debt to adjusted EBITDA. Protecting their investment-grade credit rating right now is paramount.
So they want to reward shareholders, but they refuse to compromise the balance sheet to do it.
Right. As of the end of the quarter, they were sitting on a fortress-like $2.1 billion in total liquidity.
Okay, so we've established how Hyatt is generating and distributing cash today. The asset-light engine is humming. The core fee business is insulating them from the regional shocks in Mexico and Jamaica, and shareholders are getting paid.
Yeah.
But, the stock market is relentlessly forward-looking.
Always.
So we have to transition to where the future top-line growth is coming from. Because if you're a franchise business, you live and die by the pipeline.
The pipeline is the single most vital forward-looking indicator for a hospitality company that has transitioned to an asset-light model.
Right, because you no longer own the buildings.
Exactly. You cannot grow your revenue by simply raising the value of your real estate. You have to constantly add new franchisees to the system to generate more royalty fees.
So currently, their trailing 12-month net rooms growth sits at 3.9%, or, to be fair to the math and the accounting noise we discussed earlier, 4.4% if you exclude the rooms from the Playa acquisition that were removed from their permanent room count late last year.
But that trailing metric is, somewhat backward-looking. The future pipeline, The executed, legally binding contracts for hotels that are currently under development but haven't opened their doors yet is massive.
Oh, massive.
They are sitting on a pipeline of approximately 154,000 rooms.
Wow.
Yeah, that represents a 10% increase year over year in their backlog of future inventory.
154,000 rooms. Where are they finding the real estate for that kind of expansion?
They're heavily targeting high-growth international markets to diversify away from their historical concentration in the United States.
Makes sense.
During the quarter, they announced a major strategic master franchise agreement with Dawson Group. And this is a really crucial strategy.
Because a master franchise agreement means Hyatt isn't going over there and trying to navigate local zoning laws and construction permits themselves, right?
Exactly. They partner with a massive local player like Dawson, who aggressively develops and operates the physical real estate for the Hyatt Select brand across mainland China.
So they are tapping directly into the explosion of domestic Chinese travel by letting a local expert take all of the development risk. And Hyatt just, slaps their mid-tier badge on the building and collects the franchise fee.
Precisely the model. And they're executing a similar strategy on the luxury side in other emerging markets, too.
Like where?
Well, they highlighted the upcoming launch of the Barai Hua Hin, which introduces their high-end Unbound collection brand to Thailand. They are systematically planting flags in regions that are experiencing rising middle classes and massive state investments in travel infrastructure.
Okay, while that 154,000 room pipeline sounds incredible on paper, I want to challenge the math on their immediate 2026 guidance.
Do it.
Management's official full-year guidance projects net rooms growth of approximately 6%. We are halfway through the year, and the trailing 12-month growth is only at 3.9%.
Right.
Getting to 6% by December 31st requires a massive acceleration in the back half of the year. Are they projecting a hockey stick growth curve that just sort of defies the reality of global commercial construction?
It's an aggressive target, for sure. But you have to look at the sheer volume of that pipeline. When you have 154,000 rooms under executed contracts, the math works in your favor.
I guess so.
If even a fraction of those properties receive their final permits and clear their final inspections in Q3 and Q4, that 6% target is mathematically achievable based purely on the volume of the backlog.
But mathematically achievable and practically realistic are two very different things, especially when you're dealing with supply chains, local government permitting, final construction handovers.
Oh, absolutely.
Yeah.
Which is why management embedded a very specific caveat into this report regarding that 6% target.
What did it say?
CEO Mark Hoplamazian explicitly noted that they are taking a, quote, measured view on the timing of openings later this year.
A measured view.
Yeah.
When a CEO says that on an earnings report, it's corporate speak for expect delays.
It is a very clear hedge. The report goes on to state that the net rooms growth outlook is heavily weighted toward expected openings late in the fourth quarter. And they acknowledge the high probability that some of those final handovers will slip into early 2027. The contracts are signed, the revenue is coming, but pinpointing the exact quarter the doors open is subject to friction they simply can't control.
And beyond just supply chain friction or construction delays, aggressively expanding your footprint globally introduces an entirely different set of unavoidable macroeconomic risks. You cannot plant flags in every corner of the world without exposing your balance sheet to the instability of those regions.
And the Q2 data provides a really stark example of exactly that geopolitical risk.
Yeah.
Buried right in the middle of their operational statistics, you will find the comparable system-wide RevPAR data for the Middle East and Africa region. That specific segment saw a devastating 28.3% decline in RevPAR year over year.
28.3%.
Wow.
Yeah. Occupancy in that region plummeted by over 18 full percentage points. And that is because of the ongoing tragic geopolitical conflict in the Middle East. It just instantly evaporated travel demand in the surrounding area. We are just reporting what's in the earnings here, but the financial impact is undeniable.
Yeah, management actually quantified the broader financial impact of that localized drop. They stated that the conflict in the Middle East negatively impacted total global system-wide RevPAR growth by approximately 110 basis points.
110 basis points. For the retail investor, that translates to 1.1%.
Right.
So if that conflict wasn't happening, Hyatt's global RevPAR growth would have been an incredibly strong 7% instead of the 5.9% they reported.
Exactly.
It is a sobering reminder that a massive global pipeline brings unavoidable exposure. You cannot divorce this asset-light revenue stream from the reality of global events.
And that reality brings up a fundamental question about the very nature of this industry-wide pivot.
Exactly. Which brings us to a final thought for you, the listener, to ponder beyond just the spreadsheet math of this earnings print.
It's an important one.
As Hyatt, and frankly all of its major peers in the hospitality industry, race toward this 90% plus asset-light model where the parent company relies purely on franchise and management fees, who's ultimately left holding the bag on the physical real estate risk.
Well, it's the franchisees.
Right.
It's the local third-party real estate developers, the regional ownership groups, the private equity firms that actually bought the concrete and signed those 50-year management agreements.
Hyatt has brilliantly and successfully offloaded the capital intensity of owning buildings. But just consider the macroeconomic stress test.
Right.
If a severe, prolonged global economic downturn hits a scenario where corporate travel budgets freeze, inflation crushes the leisure consumer, and interest rates remain elevated, does this asset-light model truly protect the Hyatt brand? Or does the financial strain simply shift to the local property owners who are burdened with the massive mortgage payments?
Yeah, because if a major franchisee in Dallas or Dubai defaults on their physical real estate, they can no longer pay their software licensing fee to Hyatt.
Exactly. A wave of local franchisee faults will eventually cascade right back up to the parent company in the form of broken contracts and evaporating fee revenue.
It really is the ultimate stress test for the SaaS model of the hotel industry. And it's a structural dynamic every hospitality investor needs to be watching closely in the coming years. As these companies shed their real estate, the health of the individual franchisee becomes the single most important metric for the parent company's survival.
And that's the real story beneath the headline numbers today. Make sure to follow the show for your daily, no-fluff earnings coverage. We'll be back tomorrow to dive into the next stack of reports.